So we are at the Kenya Mortgage Refinance Company. Tranche 1 of the medium-term note was very successful, and they just did another tranche 2, which this time around was based around sustainability. What are the plans around it? And even what did they do over that period of time with the first funds that they got? I'm here to have that chat with the CEO. Welcome to the Trading Bell. Welcome to the show.
Thank you. Very nice to see you again.
Same to here. And first of all, let's start with the congratulations.
Thank you.
So your maiden bond in 2022 raised 1.4 billion shillings and was oversubscribed by 480%. Could you walk us through what the proceeds were deployed to and where did the money go?
So the 480% of our subscription was our inaugural bond in 2022. Mm-hmm. We got a very good reception from the market, which was actually amazing. Mm-hmm. It was a little bit of a surprise to us, but it was a pleasant one.
Okay.
And that's because it was our first time in the market. Mm-hmm. We didn't have a track record. Mm-hmm. We didn't have any form of guarantee or credit enhancement for that matter. Mm-hmm. But look, everyone trusted us that we have a model that works, and indeed it actually does. Mm-hmm. And we are offering an essential service.
Okay.
Now, we got funds that we utilized, and we actually fully disbursed within 1.5 years.
Wow.
But the way we do it is that we...
which is actually a very good thing for people to understand.
Yes.
Lest they come to your office.
Yes. The way we do it is we actually, of course, you know what we do, refinance mortgages.
Absolutely.
We are in the wholesale market as opposed to the retail, which is usually the financial institutions.
Yeah.
But we blend the funds. Mm-hmm. So we raise capital markets funds, which of course are not cheap.
Yeah.
And we blend with concessional funds. Mm-hmm. So before we issued the bond, we had already mobilized about 35 billion Kenyan shillings ahead of time, which is essentially the resources that we sought to blend with the capital markets funding. Yeah. And usually when you do that, you reduce the weighted average cost of funds, because here we're dealing with affordability, which is actually the biggest concern anyone will have in a market like Kenya.
Wow, that's very good. So maybe someone would ask, how would you rate it in terms of the deployment of the cash from since you did it till now when you felt you needed to come back again? How would you say the success rate was?
The success was excellent. I mean, the fact that we quickly got the kind of funds we needed only about 1.4 billion. We got over 8 billion. We started getting feedback from the market that, you should have had a green shoe option and then you take all the money. But we really didn't want to do that because we have an issue that we needed to address, which is affordability. Okay. And so our first bond was actually a market tester. The full deployment of funds is an indication that the market is actually very receptive on the affordable housing part. We build a pipeline of mortgages or home loans that we refinanced. And the uptake has been extremely good.
Wow, lovely. It has always been a case where we used to say that mortgages in the country have always been a very low percentage. Yes. And we appreciate the effort to bring it at very good costs. I've also seen some of the institutions you partner with giving it at single digits, and that's amazing.
That's right.
Now, let's move on a little bit. There's a word you've used there, blending. Commercial blending, commercial bonds proceeds with concessional funds like DFIs. What does that blending look like in practice, and why is it critical to keep these rates affordable?
Yeah, so we have an issue of affordability, and that is mainly because of the kind of incomes we have in the country, particularly on the lower end of the market, which is essentially where the biggest challenge is. Now, we have concessional funds, but what we're really looking at is sustainability.
Yeah.
How sustainable are the funds we have? Now, our sustainability strategy is actually predicated on local currency fundraisers. That's why we go to the capital markets to raise funds locally, because that's sustainable. Concessional funds are good, but of course it's not sustainable. I mean, you can dry out whenever, anytime. Yeah. So the blending we are talking about here is essentially getting a pot of lower cost funds, and we get a pot of higher cost funds. The lower cost funds is the concessional funds I'm talking about, which is the 35 or so billion that we had raised from the World Bank and the African Development Bank. Then we have the higher cost funds, which are usually capital markets funds, because of course they are higher cost. Now you put the two in a pot and you blend. I mean, that's the simplest way of saying it. Now what you get is a lower weighted average cost of funds. So when you look at the higher cost funds, it was 12.5%. The lower cost funds we had was about 4%. Now we blended the two and we got a weighted average cost of about 5%. And that's how we then lend to the market. But what were we actually trying to solve? The biggest issue that we're actually trying to solve is the asset liability mismatch that we have in our markets. The asset liability mismatch is common with financial institutions, which are deposit funded, because deposits are short term. Now, when you put that in long-term assets like housing finance, then you run into a mismatch risk. And that mismatch risk usually prevents financial institutions from lending possibly to housing at scale. They can only apply a certain quantum of funds for longer term assets. That means in their risk appetite, they can only take so much of risk on the mismatch. So what KMRC has come to do then is to actually remove that mismatch risk. So the blending extends the tenor of funds, right? And then it also reduces the cost, that is the interest rate. And that's why KMRC is lending in single digits. Any KMRC supported funds or home loans or mortgages in the market are actually in single digits, and they are even longer term. The other key thing we addressed was the variability of rates. So we also then started locking rates so that they are fixed rate. And the way we did that is we actually locked the financing, both the concessional and the that's capital markets funds. That's why you see our bond is fixed rate, right? It's fixed for the tenor, because we want to move the market to fixed rate home loans, and that actually addresses the risk of defaults, which happen from time to time. When markets change, the rates change.
So let's talk about the gap between tranche 1 and tranche 2. There was a whole 4 years. I'm sure there are so many lessons in between that you learned, and I'm sure even in tranche 2 you came well equipped with that. So anything that you may want to raise in terms of how you learned managing a capital markets program alongside an affordable housing mandate?
Thank you. So the difference on the duration between tranche 1 and tranche 2 was mainly just driven by macroeconomic conditions of the market. So and the lesson we learned there is market timing is critical. It's very, very essential to obviously ensure that you time the market. At the time, 2023 to 2025, inflation rates were high. Interest rates obviously tend to go up. The policy rates equally. Well, I mean, the central bank, of course, was trying to manage inflation, and therefore they tended to address their policy rates in that regard. And that just made it difficult for us to get to the market. We are we have sensitivities on costs. So cost of funds to us is some very sensitive issue that we actually had to address. So there was no way we can go to the market and issue a bond of 15%, for example, or 16%, based on the condition of the market at that time, because that significantly affects the cost at which we are going to extend financing to the market, and that creates an affordability issue. So we have to keep timing the market. The right time was actually now when we went to the market.
Okay.
We could have gone to the market. I think we had actually earmarked to go to the market in 2024. We again changed. We said, okay, we will go in 2025. But when we assessed the market, we were not ready to issue at the kind of cost of funds that we were going to attract at that time.
Okay.
Yeah.
Let's talk about tranche 2. It's structured around sustainability, which is quite an interesting phenomenon to some people in the country who are getting to learn about this, but also in the corporate field, this has been the trend of looking at how sustainable is what is being offered. And you talked about on a fixed rate note, not just any conventional corporate bonds that we see.
Yeah.
Maybe you could shed some light on that. Why sustainability label and what it stands to the market?
Yeah, we have a sustainability framework, which we actually put together since 2024. Now, our target is actually to shift markets or home ownership to shift into environmental friendly situations.
Okay.
Now, when we develop a sustainability finance framework, which we did last year, we had to ensure that the sustainable finance framework is aligned with the International Capital Markets Association Green Bond standards or principles, the social bond principles, and even the sustainability bond guidelines.
Okay.
Now, we got a second party who actually did a review. We got an institution in the US called ISS Corporate, which did a review of our sustainability finance framework to make sure that it's actually aligned with the international standards that we are talking about.
Yeah.
And they confirmed that it's aligned.
Okay.
Now, so the arrangement here, or the focus that we have, is actually to shift the market to green affordable housing. We want to reduce the carbon, or at least to facilitate the market or people to reduce the carbon footprints, which are, of course, usually comes out of housing. We want the market to start focusing primarily on generating mortgages that meet certain standards, that's environmental standards. Like, for example, reduction of carbon, energy efficiency, water conservation, So those are the areas that we want the market to address. And that's exactly the strategy we have. We want to shift the market to go green, green affordable housing, which is essentially what we want to support. And it's a wider perspective of, addressing climate mitigation measures within our country.
Let's get deeper into that. There are some terms you've used there. Eligible green home loans and eligible social home loans, Maybe you could help us to distinguish between that and what exactly qualifies a mortgage and each category.
Yeah. So a green home loan is an arrangement or pool of home loans or mortgages that will consider mainly at least a 20% increase or reduction in energy, for example. Potentially have some form of water conservation, and it will certainly be meeting certain standards. Like, for example, you can have the IFC Edge certification as one of the measures that we'll be looking at. So when an institution originates a pool of mortgages, we have an eligibility criteria under the sustainable finance framework. And those are the measures that are used to define what a green mortgage will look like. And of course, the application of funds, because that's the primary issue around why we have a sustainability bond, is mainly on the application of funds. 100% of the funds will be applied on those mortgages that meet the green and the social framework.
Okay.
Now, the social part is even more interesting. So it is, it's mainly predicated on affordability. So how do we define affordability? We have income thresholds, for example. So we say an income threshold of up to 4 million will be considered lower income socioeconomic empowerment, right? So we then are saying we are pushing financing down market, and that is achieving a social objective of socioeconomic empowerment. And that's why we put a cap of 4%, 4 million and below.
Okay.
The other consideration we look at is just social diversification. Like, for example, we are saying how much of the funding we provide go into women-led households.
Oh.
So we are talking about...
Is this a social part of ESG?
That's part of ESG,
okay,
exactly.
I see what you're saying.
Exactly. That's part of the ESG. So we are meeting ESG standards.
Okay.
And so we are saying, as part of the social part,
okay,
we'll be evaluating the number of home loans that originated that actually go to women-led households. And that is part of the application of funds under the social category. So it's social empowerment, it's women-led households, it's lower income, the lower income people who obviously usually have a disadvantage because their incomes are very low.
Okay.
And they're actually even considered high risk. And that's why we are pushing that agenda down that way.
Oh, I love that. So you've raised 4.4 billion against a program ceiling of 10.5 billion. So you still have about 6.1 to go and for your headroom. So what is the pipeline of future issuances and how many tranches probably over the horizon?
Yeah. So we have a significant pipeline that is coming up because we moved into lending beyond the shareholders.
Okay.
We opened up our lending framework, I think, in 2024. Initially, we were only lending to the 20 shareholders that we had.
Okay.
Now we diversified a lot and opened it up to the entire market, which anyone who is offering mortgages, both banks and SACCOs, can originate a mortgage and get refinancing from KMRC. So that's leading to a more significant increase on the portfolio of mortgages available for us to refinance. With that kind of arrangement, we are seeing us going back to the markets sooner. Next year is an election year. Perhaps it may not be the right time to do that because the market timing is still a good thing to do. But we are likely to go back to the market in 2028. Now, we have an option, but that, of course, will be dependent or driven by our funding gap at that time. So that's why we'll at least issue one tranche, at least. That means we can do two. Right? But that will certainly be the maximum tranches that we'll be issuing. But we usually assess the pipeline of mortgages that we have, or demand for that matter. We look at the concessional funding we have, and then we equally look at, so how much market funding do we need? And when we identify the gap, that's actually when we come in to seal that gap. Because the issue here is that the concessional funds have to be slightly higher than the market funds, so that when you blend them, the average comes down. And so we have to keep managing that. We have a blending model that we actually use for that purpose.
Are you happy, first of all, with this fest?
We are very happy.
Just checking.
An oversubscription of 300 is excellent.
It's very good. It's very good, And finally, and I love the fact that you've talked about the huge number of SACCOs coming in, even at the banks as well, which probably would broaden the reach in terms of the informal sector.
That's right.
Which are the majority in the country, may not have a pay slip to just show you up. So what are you doing to ensure that as well, there's people who as well make their living can also be part and parcel of this?
We are doing something more interesting, which is actually amazing. We have developed what we call a Kenya Mortgage Guarantee Fund. An institution that is separate from KMRC, but of course is run by KMRC, which we call a risk-sharing facility. The idea is to de-risk homeowners on the lower income, who are actually the majority. 84% plus of income earners in Kenya are actually people who do not have a regular payslip. They don't have a regular income. It could be a taxi driver, a guy who owns a shop, a guy who, running a little business, an MSME. And the greatest challenge is that they're actually considered by financial institutions as very high risk.
Yes.
And therefore, they don't even give them an opportunity to demonstrate their ability to pay a mortgage, because that's the most important thing, your ability to pay a loan that you can be granted. And the reason why they don't get that opportunity is that of informality. You know, they don't have documents that demonstrate their creditworthiness, their credit history, which is so important for a financial institution to do an assessment. Now, so what we are doing is that when we created this Kenya Mortgage Guarantee Trust, which is the RSF or the risk sharing facility, we expect this, and it's already actually ongoing, to de-risk those lower income households. The banks will now start seeing them as an attractive lot because we are guaranteeing their loans 40% on a first loss basis. So we are saying, if you generate a mortgage of 1,000, if this person defaults, we are going to pay 400 of that 1,000, which is 40%. The rest remains, of course, as a credit risk to the financial institution to enable them to originate a good mortgage. You know, so if you cover 100%, then why will a financial institution sit and start reviewing that person?
They will not.
You know, I'm guaranteed 100%. I can recover all my money whenever. So we wanted them to have a stake, you know, which sometimes is called in jargon skin in the game. So they need to have that for them to help us in that process.
You're right.
So we are going down market. We are going to ensure that these financial institutions go there. And part of the funding we are mobilizing is also intentioned to go down that route and encourage them to apply to the Kenya Mortgage Guarantee Trust for them to get a cover of the credit risk.
I'm sure most would even be pushing to a higher percentage, like a 50% of But before we close, viewers are watching and they see you, they hear this name, they're thinking a home. So can they go to your website? Is there a place they can go and they can know the institutions where they can go to, or probably even check the circles they can go to? Is that something they can do?
Absolutely.
Yes.
So apart from the institutions that work with KMRC, and even there's even a loan calculator so that you can know your status immediately before you even go there. You just look at your income, punch in some numbers on your income, and it generates for you how much loan you can qualify for before you go to a financial institution. Apart from that, we actually even have a listing of some properties based on credible information we obtained from people who are building. We cannot attest that they're actually, you know, good for you or anything. We're just putting information out there so that if you want a home, then that's a reference point you check, and then that takes you now to where the property exactly is, and you go and check. And obviously now start thinking whether that's the kind of property you want to buy or something like that. So our website has a lot more information, and so we ask viewers, please go, and you should be able to get a lot of assistance. We are also even available on phone, on social media, I think, all form of social media. And we can be reached and we can support whenever someone needs help.
So there could be someone who says, I have a plot and I would like to put up something. Does KMRC, through its partners, support this kind of process?
Yes. We call it buy to build. You can actually take a loan, you buy a plot, and then you take a loan and do the construction. Part of that is actually known as incremental home development, because you buy the land, then you start construction, you go up. And KMRC supports that as well. So you can go to a financial institution, get all that, and KMRC will refinance the plot, home, construction that you're doing. Yes.
That's very good news. I have someone who has a plot and wants to do that.
They can be able to get that doing.
Thank you so much for your time. There you have it. It's all about owning your own particular home, or probably even helping others do the same thing. And we want to appreciate what the Kenya Mortgage Refinance Company is doing. There has been a conversation with the CEO, and he's very optimistic about really even making homes green. I mean, looking at matter sustainability and touching to the fabric of the social, and really all matters ESG. Thank you so much for your time. I'll leave you now with the markets.